Morning. Uh, Welcome, everybody. I'm Mark Rector with Lloyds. I'm also the Executive Secretary of the Association of Lloyds Brokers, and I'm very happy to welcome you all to today's program. It's our final session from the for the Association of Lloyds Brokers. We've done programs on the Lloyds market at the beginning of the year, mergers and acquisitions, high net worth property. So we thought it would be appropriate to circle back at the end of the year to again look at what's going on in the Lloyds market. And we've got a really great panel for you today. We're going to lead off with Chris Croft, who is the Chief Executive of the London and International Insurance Brokers Association in London. He's going to give us the London brokers' perspective on the market. We'll have Ed Gaze and James Falconer from the Lloyd's Lab to talk about what's going on in innovation in the market. And finally, we'll have Pat Talley, who's a US regional director here in the States for Lloyd's, who is going to talk about what the Corporation of Lloyd's perspective is on the market, not only emerging from the pandemic, but how the market's looking going forward. So it's a very exciting program. We'll have some polls for you. We'll probably take a break after we hear about innovation so we can get up from the screen and stretch out a bit, get a cup of coffee. And afterwards, and I'll drop a link into the chat about this, but afterwards, you can get 3 hours of continuing education credit in Illinois and Wisconsin by visiting linktolloyds.com. There's a link there where you can fill out the form, and we'll file that CE credit for you this week. I think that's about it for me. As we go along, if you have any questions, please drop them into the Q&A tool, and we'll try to get to them. Otherwise, I'm going to stop sharing my screen and turn it over to Chris. Welcome, Chris.
Thanks, Mark, and good morning, ladies and gentlemen, or good afternoon from me. Very good to be able to join you this afternoon live from the heart of the London insurance market in Lieber's offices on Leadenhall Street. Admittedly, this isn't as convivial as luncheon in Chicago overlooking the lake, which was where I was when I last spoke to you, but in these strange times of ours, we take what we can get. And with borders now open again, I do hope we can do this in person again sometime soon. As some of you may remember, I was with you for that luncheon 3 years ago. Then I spoke about London, its role in the global market, and the work we were doing to maintain its leading position. I advised you not to worry about Brexit and that we had it covered and it would not impact you as US buyers of insurance in London. And I made some vaguely disparaging remarks about the person who, for the moment, we must refer to as the Duchess of Sussex. Now, given the pace at which things progress in London, or in the case of that latter point, deteriorate, a world in which it sometimes feels that glaciers would get pulled over for speeding, I was tempted just to trot out the same speech again and see if anybody noticed. But whilst that is how it may seem when one is involved day to day in the business of the market, the truth is that, in fact, things are very different than they were in those somewhat innocent days of 2018. We're a market much changed, but hopefully also one that retains the key features that allow us to deliver outstanding service to our clients. Let me start by talking a little bit about the experience that has driven so much of that change, the market in lockdown as we battled the COVID-19 pandemic. On 16th of March 2020, our government advised that people should work from home if they could. I remember sitting on the 7:04 p.m. train from Cannon Street Station that night, and it feeling a little bit like it was the 3:10 to Yuma, a group of people headed for a life they could not quite contemplate, but that certainly promised to be a lot less free than the one we were leaving. A week later, on 23rd of March, that advice was enshrined in law and lockdown 1 began. It lasted until our own version of Independence Day on July the 4th. but subsequently we were back in lockdowns in November, and from January through to the end of July this year, comfortably more than a year of legal restrictions on our movement, with the legacy of caution and changed behaviour affecting us now and into the future. That government phrase, work from home if you can, seemed to apply to us because we were office-based and there was the internet. But despite firms' business continuity planning and operational resilience programs, no one was really sure if we could work from home philosophically. Ours is a relationship-based market that thrives on face-to-face personal interaction. How is all that going to work if all you could do was to appear on a little screen, live from your garage, in my case, or your kitchen, or your bedroom? The answer was that, perhaps surprisingly, it's worked very well. Business continued to be traded. The electronic platforms that we had been adopting anyway provided the lifeline that we needed. Some members of my organisation, who had previously railed a little bit at their trade association urging them to up the pace of their adoption of these methods, had to grudgingly accept that we'd been right all along. One member of my board, a man not known for his aptitude with computers, will happily say that the service provided by Placing Platform Limited, PPL, which is the predominant electronic trading platform in the market, saved the market. It meant that, as domestic markets tightened in the face of uncertainty, London was there to play its principal role in the global industry, to be the market that provides cover when others cannot. Year on year, 2019 to 2020, we saw direct business flows from the US up by about 25%, and it was 40% for reinsurance. When our clients needed us most, we were there for them. That's a very positive story, but for balance, I should emphasize that it's mainly a story where the romantic heroes are our existing clients. The ability to develop new markets and bring new business to London has undoubtedly been hampered by our inability to get to come and see you all. And so we're delighted that as of 5:01 a.m. here on Monday, restrictions on travel to the US have been lifted. Expect a flood of London brokers coming to see you and to see where we can be of more help, as well as catching up on shopping on your side of the Atlantic in the run-up to Christmas. That return to travel is going to be a feature of how we return to normality, albeit somewhat tempered by the fact that Zoom et al. Have shown that they can work for a lot of meetings that previously would have required a flight, and that companies' ESG commitments, on which more later, will drive them to limit the number of people that they put on airplanes. But it's only one of a number of issues that we need to consider as we seek to emerge from the pandemic in the best shape possible. How do we marry the best of the lockdown world in terms of efficiency, flexibility, and work-life balance with the key pillars of the old world: innovation, face-to-face negotiation, and a collaborative physical working environment, to deliver the ultimate offering for our clients? This is a subject that's occupied quite a bit of our time at Lever, partly because it's fascinating, but mainly because if we don't get this right, we threaten the very foundations of how our businesses work. We published a paper as an association, 10 Key Principles for the Future of Our Market, in March, which stirred controversy in the pages of our Daily Mail newspaper for its passing suggestion that people might not wear ties much anymore. At CF Me Today. We envisage the brave new world to be one where, above all else, the needs of our clients will be paramount. So that means that, whilst we've seen the folly of previous office presenteeism and enjoyed the much more flexible approach to how and where you do your job, most client-facing roles will need to retain an office focus. You're likely to need to be there more often than not, probably not 5 days a week every week, and possibly not all day if that makes sense and makes commuting more convenient, comfortable, and cheap. But you will need to show your face and interact with people. At this point, I'll now accept that the greatest cliche to emerge from the pandemic in terms of work, that people need to co-locate physically in order to collaborate and innovate, is only a cliche because it's true. But we think there's more to it than that. Business in London can still happen almost by chance. That serendipitous meeting on the street that leads to a conversation and on to a deal. That will only happen if people are here pretty often. and that is starting to happen. I'm in London now, certainly 3 days a week, and it's no longer the ghost town it was if you ventured in a few months ago. Tuesdays, Wednesdays, and Thursdays, I would say, are back to about 80% of pre-pandemic capacity. And Mondays and Fridays don't find the city any more deserted than they were tending to be anyway in the early days of 2020. Flexible working, as with our adoption of electronic trading, are two pertinent examples of the overriding effect of COVID. Lockdowns and the like did not really create any new practices, they just accelerated trends that were already in play. And it's probably because of that that London coped so well, and that you, our clients, remained well served. There's one specific and quite big question about the future of our market that I've not yet touched on. So let's get to it now. What do we do about the underwriting room at Lloyd's? From coffee house to atrium, the room has always been the focal point of our physical market. But if that market is to be more flexible, possibly slightly more disparate and less formal, then will we need that focal point to remain? My answer to this is a resounding yes. And I say so because of a number of factors. Firstly, being the makeup of my membership. The Lloyd's broking community that LIBA represents is made up of 152 groups of firms that pay us any money, which is the only relevant metric for subscription-based organisations. They, in turn, account for well over 200 individual broking entities. Of those firms, only 18 employ more than 100 people. 80% of LIBA members employ 50 or fewer staff, and half of our flock employ fewer than 10. We are a vibrant, expert, niche SME sector in and amongst the global insurance behemoths. Already pre-pandemic, to revert to my COVID has not created anything, just accelerated things theme, a number of those smaller members were giving up EC3 office space in favour of cheaper accommodation in some of the satellite towns around London that are within, say, 45 minutes to an hour's rail journey into one of the city terminuses. Lower overheads day to day with the ability to easily access underwriters whenever needed by hopping on the train. But people like that will still need somewhere to mill around between meetings. And that milling, even in days when you did have an office to go to, has traditionally happened in the room, as well as a number of famed hostelries in the environs of the room. So that need will only have expanded. And milling's a good thing. Without coming overall technical, economic clusters like the London insurance market are able to deliver collective outcomes better than the sum of their parts because of the ability of actors to engage in what economists like to call tacit information exchange, and what you and I would be more likely to call market gossip. Trends, threats, opportunities, what Kate said to Fred last Thursday, and why Antonio Conte is the wrong man for the manager's job at Spurs. I know many of you will not get this soccer reference, but I had to keep it authentic. So the future of our market does rely, in part, on providing the framework that allows this vital milling around to take place. The room is a key part of that infrastructure. And so, whilst it might be a bit more beanbags and a bit less boxes, its role remains crucial. And add to that is that it will still retain a role as a trading venue for many lines of business. Plus, it's an iconic part of client visits to London, and thus to our market's overall brand. And I think the case for retaining the room is overwhelmingly made. And it will remain at the beating heart of a thriving market. I know from discussions with people on our board that recent slightly ham-fisted reporting of the latest performance management round has led some US clients to worry that Lloyd's was stepping back. Nothing could be further from the truth. The market is in rude health and has plans for growth. It remains an excellent choice for all your commercial insurance needs. 3 years ago, I got to this point and felt compelled to talk about Brexit, mainly because in those days, Brexit was a subject no British person could go for long without mentioning. In 2018, my message was simple. Don't worry about it. Our members, Lloyd's and the insurers were already deeply immersed in the work, which meant that you, our US clients, would not be adversely affected by the revision of UK's trading arrangements with our continental friends. Today, my message is similar. Forget about it. In the over-repeated words of our Prime Minister, Brexit is done, and the ability for UK insurance brokers to find suitably licensed cover for their US clients with EU assets is unaffected. I said last time that we got this, and we did. But there is one wider implication of Brexit that I would just like to pause on, because it's an issue that's not confined to the relationship between the United Kingdom and the European Union, and it could have global ramifications. What Brexit has exposed is that the legal basis for some international insurance trade is not as certain as it might be. Business where a client in one country seeks covers for assets in others, what we call multinational placements, is a vital foundation of global economic activity. But it is somewhat fraught with challenges of definition when viewed through the legalistic eyes of our regulators. There are several crucial questions to answer to drive regulatory attitude. Somewhat inconveniently, however, there are several more potential answers. Take the question of where a risk is located, for example, key to determining licensing requirements for both brokers and insurers. Simple, you may think. It's where the thing you are insuring is, right? Well, Chris, as my university economics tutor would say when I'd given him palpably the wrong answer to a question, maybe. But what if that thing moves, like a ship or a plane? There's a reason why most ships tend to be registered in Panama. But the Germans have recently tried to insist that any ship listed on their official documents is located in Germany for insurance and tax purposes, regardless of where it is physically. Plus, up until now, we've tended to argue that offshore oil rigs that are located in international waters are not located in any specific territory, and thus not liable for any of those territories' insurance premium tax. But our HMRC, Her Majesty's Revenue and Customs here, is challenging that interpretation. It's saying that, in these instances, the risk is located where the legal entity that would benefit from the claim payment is headquartered. And if that's the UK, then they want their 12% IPT from the premium. Similar questions arise when it comes to where an activity is deemed to be delivered. Most EU regulators will say that if you're an intermediary working on a contract where both the policyholder and the risk are located in the EU, then regardless of where you are sat physically and regardless of where you may sit in any distribution chain, then if you deliver a service that falls within their definition of insurance distribution, you are delivering that service in the EU and you must be suitably authorised to do so. Conversely, our Financial Conduct Authority would say that if you're sat in London talking to an underwriter, then regardless of where the risk is located and regardless of who the policyholder is, if that conversation constitutes insurance distribution according to their currently identical definition, then you're delivering a regulated service in the UK and need to be suitably authorised to do so. And you could easily be doing both at the same time. So the regulatory treatment of multinational placements is fraught with issues for interpretation and fraught with inconsistent interpretation. What Brexit has done is shine a light on these issues and brought more regulatory attention to them than might otherwise have been the case. And that is not necessarily a good thing. In the end, you would hope that sense would prevail, that there would be a general acceptance that these placements are pretty vital to ongoing international trade, and that they're made on behalf of clients who are more than capable of looking after themselves. But we need to be aware that there is a level of uncertainty here, and that is something we're going to have to live with for the moment. And whilst we're on the subject of challenges we've sort of brought on ourselves, it would be remiss of me, as COP26 rumbles on in Glasgow, not to touch on the issue of climate change. I know this is a controversial topic in the United Kingdom, and this is doubly true in the United States, so I don't intend to go into the wide debate today. But I would like to just touch on this crucial role that the insurance industry and the broking community in particular is going to have to play if the world is going to meet the net zero commitments we're seeing being made this week. Since insurance is entwined in every level of economic activity, our industry will be at the forefront of the response. More specifically, insurance brokers will be pivotal in helping the world achieve its net zero ambitions by 2050. Just think about the many and varied ways in which our community can influence action. We work with clients from the point where they begin to assess the risks faced by their business. More and more of these risks will be climate related, and already insurance brokers lead the field in the ability to model that threat. We will then work with clients on the ways to best mitigate these risks. That will involve building in resilience and sustainability into operations, and only once that has been deployed as a solution, looking to ensure the remaining risks through policies that themselves, in negotiation between broker and underwriter, will need to become more climate aware. But getting to net zero will not just be about adapting the way we do things today. It will also be about doing things quite differently and embracing new technologies. In our relationship-based industry, as I've already touched on, we know that international travel will not go away if we are to continue to develop business for our vibrant UK export sector. But how we travel will change. Already I've sat in on discussions about electronic ferries and electronic airliners. If these, as yet relatively untested new inventions that are come into commercial use in time for 2050, will need to find innovative ways of ensuring the risks inherent in that. After all, more and more these days, insurance is the study of sizable amounts of historic performance data. We simply won't have that here, but we need to find a way not to let that get in the path of progress. I'm reminded that when the first motor insurance policies were being drafted, as 19th century turned to 20th, the approved Lloyd's wording for defining an automobile was a ship that sails on land. We may need to achieve similar levels of innovative thinking to meet the challenges of ensuring this new wave of disruptive technology. And that is where I do fear we may have an issue. In the large part, the need for vast amounts of data to support underwriting decisions is driven by the attitude of our regulators. So if we're to be the bedrock of net zero that those same regulators are telling us we have to be, then they're going to have to play their part. They will have to discover the flexibility and adaptability necessary to allow them to adjust their approach to ensure markets can be formed around the necessary new products. Unfortunately, flexibility and adaptability are not words that you would generally associate with regulators, particularly not R2 in the UK. Our Treasury is already engaged in a review of the regulatory framework in the UK, and this is a key issue we have flagged with them as part of our input to the consultation. It has to be hoped that this appeal to a higher authority will have the desired effect. Some clients will be easier to steer in the right direction than others. We have a customer base that includes fossil fuel energy dependent businesses and indeed the producers of fossil fuel energy itself. We would not want to, nor would our regulators let us, leave these businesses behind. And on a practical level, nor should anyone want us to. After all, who is more likely to be the biggest producers of sustainable energy in the future than the likes of Shell and BP? We need to play our part in helping them get there. So that will involve a structured insurance plan to support independently accredited approaches to achieve net zero in each of these businesses. A plan that sets milestones along the way to that achievement and rewards meeting those interim targets with better, cheaper insurance cover as the firms progress. At LIBA, we're in discussion with our membership on how we develop the necessary market framework to support this approach. We hope to be able to talk more about this in the coming months. Which brings us to another challenge for the wider economy, how we measure and track progress against those net zero ambitions. Insurance brokers will also be at the heart of developing ways for clients to assess their carbon impact. And we'll need to do the same in ourselves, in our firms. Already at LIBA, we're taking the first small steps on this path. The somewhat plastic heavy water cooler has been taken away, and we've got a new bin to help us be more disciplined in recycling all we can. Small steps that cumulatively across society should help us reduce our footprint. The final big ticket item on our agenda is that of culture. We all appreciate that the more diverse and inclusive a culture you can develop in your business, the more effective and creative that business will be. But attracting candidates from as wide a pool of talent as possible is difficult, especially when you're seeking to attract them to insurance, which doesn't have the most glamorous of reputations. Which is a pity, because we do actually have quite a glamorous story to tell. Look at the sorts of things that get insured in London. Sports people, sports events, live music events and festivals, famously Ernest Gayo's nose. Away from the obvious, 90% of the world's aviation industry, international trade across the globe, and as I've just set out, the foundation of the world's sustainability agenda are all underwritten in London. And look at the social good. It's not the governments on the front line of putting people's lives back together in the wake of catastrophe events. It's the insurance industry. All of which should make a compelling piece of marketing to new generations when considering their career options. We just need to get better at making it, and making it in the right circles. But at LIBA, we see a further challenge, and it's back to those membership statistics I quoted earlier. Half of our membership has fewer than 10 staff. That means they simply do not have the resources to have dedicated teams focused on diversity and inclusion initiatives. But they are just as keen as everyone else to make a difference. So we see a role for us as their trade body to help give them opportunities to participate. Last month, we gathered a group of around 50 science, technology, engineering and maths students for a 5-morning course during their school half-term break. We worked with a charity to source students from underprivileged backgrounds across London and developed a war story centering on a cyber attack. Experts from across our membership, including staff from some of our smallest members, then spoke to the students about how their role would react in these sorts of circumstances. At the end, the group splits into teams to present back to our core group of coaches. What we've created, at the very least, is a group of people who probably ordinarily would never have thought of a career in insurance, who have now spent some time being excited, if you look at the feedback we've been given, about that prospect. It's an alumni group we will keep in touch with and develop, and which our smallest members can be a part of. And hopefully, some of the students might tell their friends about it, and they might want to participate when we repeat the exercise next year. Elsewhere, we're working with another charity called Upreach. It identifies high-achieving students, again from underprivileged backgrounds, and sponsors them through university. Due to the administrative burden at their end, the charity can only afford to run this program with cohorts of at least 40 students. So, as an association, we're going to underwrite the cost of a full cohort, but then offer our smallest members the opportunity to sponsor 1 or 2 students at the cost of £425 per student per year, so eminently affordable. Again, it gives us a chance to provide those small firms with access to a scheme they could never afford to fund on their own, and those students, through internship programs and other events whilst they're in sponsorship, will get access to some of the most innovative, creative and dynamic businesses in the United Kingdom. We hope to launch further initiatives over the coming year, as well as being enthusiastic participants in market level programs coordinated by the London Market Group, of which Lloyd's is also a member, along with the two insurer trade associations. These are long-term exercises. The students on our STEM week ranged in age from 14 to 18. It will be a while before we see them full-time in our market, but they will lay the foundation of a more inclusive culture, and that commitment and intent sends a positive message to staff already in the industry and those who may seek to join us. So, Lloyd's and the wider London market are beginning to re-emerge from our pandemic-compelled hidey holes. Despite lockdowns, we continued to trade, continued to thrive, and stood by our customers when other markets could not. As the world once again is able to broaden its horizons, we're committed to broadening our businesses to continue to provide the vital underpin for economic activity that insurance represents. Your Lloyd's broking community is poised to play the pivotal role in helping society meet the net zero commitments emanating from Glasgow this week. Our market is reshaped by lockdown, more digital, more efficient, but still based on relationships and face-to-face trading. We will build the new generation technical and physical infrastructure we need to support that. Brexit is done, but its repercussions may still be with us in a wider global context. But we will work tirelessly to ensure that governments and regulators focus on the vital role insurance plays in trade and growth and are not distracted by legal minutiae. And the market that is re-emerging is one that already is beginning to look a little different. And we're committed to doing the work necessary to ensure our community is more reflective of our wider society. 3 years ago, I came to Chicago to enthuse about the optimism and opportunity that we saw in our future. We've had some challenging times since then, but as we, touch wood, move past the pandemic, that buoyancy is still there. London never left you, and we're still here, ready to grow together. Thank you.
Thank you very much, Chris. It's always great to get your perspective. So I really want to thank you for taking the time to talk with us today. If anybody has any questions for Chris, put them in the Q&A tool, or better yet, raise your hand, and I'll turn on your mic and let you talk to him directly. I have a couple of questions
Sure.
I wanted to ask, and wait, give me just a second. I'm talking, but I'm also kind of running the show, and I want to I want to make sure people can see you. People don't want to look at me. There we go. That's better. Now they can see both of us. Well, I was really glad to hear you, everything you had to say about net zero and diversity and culture. I mean, that's so important for the market going forward. And I want, and also when you were talking about the importance of being able to mill around the market, where brokers and underwriters can, share soft intelligence and build relationships. And I've been wondering, during the pandemic, what is the effect on new entrants into the market? People who are joining the market as brokers and not having the ability to do that. Do you think that's holding them back, or what's being done to help them build those relationships?
So I think it was a real issue. I think those of us who'd been around the market for a while could fall back on the networks that we developed, and it worked quite well. But if you were just joining out, we actually the group of people that we had as mentors on the STEM training week that I was talking about, they were all, we wanted them to be as close in age to the students as possible. So they were all frighteningly young, including one guy who came along to the training, and I took them out for a drink afterwards to say thank you. And it emerged that this was his first trip to the city, although he'd been working at that point for Marsh for about 9 months. And that must be incredibly difficult to have joined a new industry and a new firm solely online, not even knowing how tall many of your colleagues were, because all you ever see them is on a little laptop screen. So it's something we're very conscious of, is that as we begin to come back, it's about helping those people make the connections that they may not have had the opportunity to do. And I think firms are conscious of creating the right framework in terms of groupings and entertainment events to try and help those people meet each other. It's slightly worried that we sort of have made a distinction in a lot of this discussions between return to the city and return to the office, because there's a lot of people back in the city, but not necessarily all of them going into their office, which kind of suggests they're back seeing people they already knew, but they kind of have a responsibility to also go in and meet some new people, I think. But I mean, in general, ours is a very collaborative and sociable market, and people will do that naturally, because certainly our community, I mean, you look at the people that I sit on our board who, 16 basic trading brokers, although many of them now are more chief executive than trading broker, but so they were climbing the walls during lockdown because they're just people who like to get out and see other people and interact. And so there will be a natural flow back to that, I think. And you're seeing it now. It's pretty busy here today. So, but it is a good point. We need to help those younger people who haven't had the opportunity.
Yeah, no, that's great to hear. One of that is really one of the things that sort of distinguishes the market, is that collegiality and the social aspect of the market. It's so important. Yeah. So different from any other place in the world. Just one more question. I don't see anybody raising their hand, and I know your time is important. What is your feeling about the appetite among your colleagues, the brokers in London, for resuming travel and getting to the United States? Are we going to be seeing more and more of that?
So as a pertinent example, there's one of the major software suppliers, one of their C-suite guys is coming over from the States here and wanted to meet with some of the people on our board. So I would normally trot out our members of our executive committee, but I can only raise one because all the others are in America. So they will at some point cross in mid-Atlantic. But yeah, I mean, people have been itching to get out to see existing clients, but as I touched on a bit, to develop new business, that's been hugely difficult over the last 2 years, because you need to get out to see people to build those relationships and to build the trust that sits behind all insurance trades. So yeah, I'm not sure we'll be seeing much of our board for quite a while, or indeed much of our community. They'll all be somewhere else.
Great. That's good to hear. Good to hear. Well, Chris, thank you on behalf of the association and everybody who's watching today. Thank you so much for taking the time to talk with us. It's always great to see you, and I hope to be able to see you face to face in the not too distant future.
Absolutely. Thanks for the opportunity, Mark. Always delighted to talk to you, and I do hope to come to Chicago again sometime. It'd be nice.
Brilliant. Brilliant. Well, thank you very much.
Thank you. Thanks, everybody.
I did want to mention that we are streaming this on our YouTube channel. I'll drop the link into the chat as soon as I stop talking here. And I'll also drop the link where you can get 3 hours of CE credit into the chat very shortly. We're waiting for Ed Gaze and James Falconer from the Lloyd's Lab. They're going to be with us in about 5 minutes or so. So feel free to walk away, take a stretch. I'm going to launch a little poll, and we'll see you all more or less around a quarter till the top of the hour, and we'll resume the session then. So feel free to take a little break and take a little stretch.
Crank the volume up.
Hi, Ed. Hi, James.
Hi, everyone.
We've taken a little break. People are on their way back, so we might give it just a minute. Chris ended just a little early. Thank you for accommodating us and coming on a little early. How's everything going?
Yeah, everything's good over here in London. It's just a bit dark all the time now. That's any problem.
I feel your pain.
We're in a room together. Hopefully you can hear me clearly. We'll just use one audio, otherwise we'll get a little feedback. Is my voice clear to you?
You both sound great.
Okay, cool.
Let's see. And are you going to share a presentation? Or do you want to?
Yeah. I'll grab it up now. Can everyone see that?
Yeah.
You look great. I'm just going to let everybody know we're back. And brilliant. So Ed, James, I'm going to turn it over to the two of you and I'll get out of your way.
Awesome, thanks. So I'm Ed Gaze. I run the Lloyds Lab and I'm in charge of innovation at Lloyds. And I've got our grad with us, James, who's going to be giving the main presentation, and then we'll both be available for Q&A afterwards. So without further ado, I'll hand over to James, who will take you through innovation at Lloyds.
Cool. Yeah, thanks, Ed. So hi, everyone. Nice to meet you all, even if it is just virtually. And like Ed said, today I'm going to be giving you a little tour of what we're doing with innovation at Lloyds. So first things first, to really understand what we do at Lloyds currently, we need to have a better understanding of what we've done at Lloyds to do with innovation in the past. So here we are. The first ever motor policy at Lloyds was written in 1904. And an interesting fact about this policy is they didn't really know how to describe it in the policy wording. So they actually called it a boat on land, I believe it is, or a boat with wheels.
A ship navigating on land.
Yeah, a ship navigating on land. So truly shows you that they didn't even know how to properly describe it. So really at the forefront of making new products, ensuring new types of risks. And then moving on to 1911, they ensured the first aviation policy was ever written. And as you can see, the planes have become considerably more safe since that policy was written. And then moving on to the first time that we sort of adventured into space in 1965, the first ever satellite insurance policy was written at Lloyds. I think quite an interesting fact as well is about the Apollo syndicate over here, Apollo 1969. I think one of the founders over there was best friends with Neil Armstrong. So that's a cool little fact for you. So moving on back to the modern day, we spoke a bit about innovation that we've done at Lloyds in the past, but now we're looking at what we're doing currently at Lloyds. So we've got the Lloyds Lab, which we'll speak about a bit later. Next, we've got the Product Innovation Facility and the Operations Innovation Facility. So the PIF and the OIF, and we do know that those names are rubbish and we're coming up with new ones. We've got the Emerging Risk Reports, and then we've also got Future Minds. So first things first, I'll talk about Future Minds. So Future Minds is mainly about, it's composed of junior employees from across the market. So these are people from managing agents and brokers. So unlike some of the other programs we have at Lloyds, just to emphasize, this is junior employees. And it's all about creating new products. So as you saw in the previous slides, we catered for the new sort of products coming out, the car, the plane. This is about sort of doing that same sort of thing. And it's done in an 8-week product sprint. So the first week or so is spent coming up with ideas. And then throughout the rest of the 8 weeks, they work with mentors. And these mentors are more senior people from across the market who give them advice on how to become innovative and cater to what the clients need. And then in the 8th week, which was actually this week, they do a Dragon's Den pitch to some senior members from across the market. and get feedback. And then the winners actually have dinner or lunch with our chairman, Bruce, and get some money as well, some prize money. And past themes have been intangible assets and geopolitics. So to give you a little taster of a product that came about on the event that we've just held was hydroponic farming. And this was to do with vertical farming and how this could help out with water scarcity issues and how this feeds into geopolitics. And it's all about creating up a bottom-up culture of innovation. So many people, when they think of innovation, they think of people like me and Ed, whose whole job it is to be innovative. However, what we strongly believe at Lloyd's is there needs to be a culture of innovation. So it needs to be something that people think about in their day-to-day jobs and do on the side of their jobs. So it's about making processes and systems faster on their day-to-day lives. It's not just about us doing it all the time. It's about making sure everyone has that mindset and making sure it's widespread throughout the whole industry. So moving on to the operational innovation facility, the Ivf. So here we have a picture on the left of what Lloyd's used to look like. And this is what many people still think about when they think of insurance. They think about people walking around with massive sheets of paper and basically being very operationally inefficient. And this is very expensive, isn't it? It increases the expense ratio a lot. So, and this means that the policies, this has to be reflected in the policies, and it basically means that we don't meet our customers' needs as good as we could. So as a result, we've made the operational innovation facility, which is meant to improve this efficiency to help better serve the customers' needs. And it's made up of senior members from across the market. And it's about both creating as well as sharing ideas. And this is both on a syndicate level, so within those organizations that sit within Lloyd's, as well as on a market-wide level. So how could we work together more efficiently to help reduce this expense ratio? And then it's also about supporting external companies that provide technology to facilitate this. So at the moment, we're really working with a company called One NDA. And as you may know, NDAs are a massive source of inefficiency in the market. So you have to have someone writing the NDA up. These usually they don't have a standardized format. So that means that someone on the other side has to read through the whole policy, identified where there's changes, and then it just takes up loads and loads of time. So One NDA basically had the idea of having a more standardized version of an NDA contract within the Lloyd's market. And this means that someone doesn't have to go through and write the whole NDA again. It just needs to add certain specific terms that they need. And then on the other side, that means someone doesn't have to sift through the whole contract. What they can do is identify where the changes are made, and this is much faster, much more efficient, and then time and cost saving. So a great little thing. Check them out if you would like. Moving on to the product innovation facility called the PIF. So I spoke earlier about all the innovation that we've done in the past, but to upkeep this reputation of innovation, we need to make sure we keep on making the new products going into the future that the clients need. So that's why we made the PIF. And it's made up of 27 syndicates working together. And these are all the top incubation underwriters from all of these syndicates. So people that can make things happen. And it's basically where people come if they have an idea. So if you're an incubation underwriter and you have a new idea, you come to the PIF and you try and seek capacity from other PIF members. And on the flip side, if you're an incubation underwriter and you don't have any ideas, which is sometimes it's hard to come up with new ideas, but you still want to get involved with innovation, you come to the PIF, hear other people's ideas, and then you can provide capacities to those other syndicates. And it started in 2019 with 140 million in pledge capacity. But in 2021, when there was a 2% innovation model introduced at Lloyd's, so this is basically where performance rankings and performance metrics aren't affected by innovative new products, it's increased the amount that's going to be dedicated to innovation at Lloyd's to almost, well, we predict around 660 million of potential premium income. And the one thing we're looking at the moment is parametric insurance. So parametric insurance, for users that don't know, is an agreement under which an insurer agrees to pay the insured an agreed amount upon the occurrence of a specified event. And to see when the event occurs, the insurer will use data sources such as sensors or open data to verify that if the event has occurred. So for example, if you've agreed that if a flood was going to happen at 10 centimeters, you'd have sensors put around a location that you're insuring, and when the water was to go up a certain level, there'd be an automatic payout. And this is better for our customers because it means that they can sometimes even get paid when they don't know a loss has occurred. And it's just basically saves time for everyone in the industry and helps us better serve their needs. So moving on to our emerging risk reports. So these reports aim to provide actionable insight to market stakeholders. And as you can see, we do it on a variety of emerging issues. So in the bottom right, we've got global food supply, so supply chain risk. We've got the climate change risk. We've got intangible assets. So a great bunch of different emerging risks. And we really try and cater to what the market wants. We don't sort of see these emerging risks and forcibly write a report on them. Instead, we listen to what the market actors want and what they see as emerging risks, and then write the reports based on their feedback. So the one that we are writing at the moment is to do with geopolitical risk. And we don't write these reports by ourselves. We work in conjunction with other sort of experts in their field. So for this report, we've decided to work with Cambridge University and their Centre of Risk Studies. And some of the key things that we covered in this report is the current geopolitical landscape, mitigation tools for managers, risk managers, and opportunities for innovation. And I think one of the key things that I took out of this report is the transition from a unipolar world to a multipolar world. And this basically, in simpler terms, is a move away from where America is dominating the geopolitical landscape to where it's more of a competition between the US and China. And with this comes more protectionist policies from both parties. And with these protectionist policies, more tariffs, all that stuff, it has impacts on the supply chain, which is important for ensuring risk at Lloyd's. So now moving on to the Lloyd's Lab. So this is probably the most famous bit of innovation that we're doing at Lloyd's, and is what a lot of people sort of talk about when they think about innovation at Lloyd's. So here's our team, Abby, working with one of the insurtechs, and all of those posters in the backgrounds are past lab participants. So how does the lab work? So we have hundreds and hundreds of applications from all across the world. And what we do is we have a certain amount of themes. So this year, our themes were crypto, claims, data and models, and a wildcard category. And from that, we shortlist these themes into just 24 teams who do a 5-minute pitch and a 5-minute Q&A to a bunch of experts in their field from the market. And then as a result, we usually choose around 10 teams, and they participate in a 10-week program where they get given mentors. So these are usually underwriters or brokers from the market who are experts in their field. And then we provide them with lots of different events. So we have both the events we host internally at Lloyd's, so demo day, midpoint trade show, those type of events. And we also have external events with all the network of stuff happening in London. So we have an organization called Instech London, who do a lot of networking, and that allows the people in the Lloyd's Lab to also gain exposure to the London companies market more as a whole. And as you can see, here's all the different places where past lab participants have come from. So we've got Canada and America, we've got the UK, but we've also got South Africa, Finland, Portugal. So you can really see that we are catering sort of to the global insurtech team. It's not just about London and America, it's global. And the objective is really to increase gross written premium. So it's about bringing new products to market, and this will lead to us to better serving our customers and also serving those emerging needs of the market and the clients. And it's also to improve the experience of the end client as well, and help to retain and bring more business through helping to better reach and meet their needs. And then another thing is reducing the combined ratio. So through the insurtechs, I don't know, providing better data or more accurate data, it means that underwriters at Lloyd's are more informed and therefore write better business. Or it could be an insurtech allows the Lloyd's market or syndicates in the Lloyd's market to operate more efficiently. And then that helps to reduce the cost and the expense ratio, which again improves the combined ratio as well. And here's some of the things that we believe that allow us to achieve these goals. So I think there's also 3 main benefits that insurtechs help bring to Lloyd's and insurance more generally. And I think the first thing is it brings back the focus to the client. So we at Lloyd's, we accept that we sometimes are we're very far away from the client. So there's the client, and there's retail brokers, wholesale brokers, and then it finally gets to the underwriting floor here at Lloyd's. And this means that sometimes we don't we need to better understand their needs. And the things that insurtechs are good at is they are fully focused on the client. Their whole business model is about identifying those needs from the client and then adapting to their needs and providing a product to help better meet those needs. So I think this is something really refreshing that is brought to Lloyd's through insurtechs. It enables a smarter use of technology. So I'm pretty young, but still I don't know what's happening half the time with all this new technology coming out. I don't know how to use it. And I'm sure many people within the Lloyd's market and in the corporation are just not only don't know how to use technology, but don't know all about all the different type of technology out there. So having people, experts in their field, know how to apply the correct technology to the right problem is something that insurtechs are really good at doing it. And another one is integrating a new perspective. So a lot of insurtechs are run by younger people. They also have less corporate bureaucracy. So they're able to sort of share new ideas and adapt to the changing needs of the client, which is something I believe is really good and adds value and provides innovation to the Lloyd's market. So that's enough of the sort of theoretical side of things. And now looking more at past lab participants. So the first one, which some of you may have heard of, is Parcel. So Parcel was actually started by someone who used to work as a humanitarian in Africa, doing vaccines for stuff like HIV and all those type of diseases over there. But whilst he was doing that, he wasn't sure about the quality of the vaccines that he was giving to people, because how did he know the journey that the vaccines has been on? Had they been in the right conditions? Were they looked after properly? Yeah, those type of issues. So what he decided to do is he went away and he designed a sensor, which you can see on the left of the screen. And this is quite a small sensor. It's probably maybe the size of my phone, would you say?
Smaller than that.
Even smaller than that. And yeah, so this provided data to insurers based on a bunch of different issues, such as the location of the vaccine transportation, the container it's in, the temperature of the container, if the container suffered any shocks, if the container was dropped, stuff like that, which may obviously reduce the quality of the vaccine or break the vaccines, and the humidity of the container. And these are all very important things to understand in order to assure that when the vaccine arrives to the final client, that it is working all properly. And basically throughout the Lloyd's lab, we discovered that this sensor worked very, very well, to the point where now Parcel is actually a syndicate at Lloyd's, and it underwrites the vaccine transportation for the COVID-19 vaccine to low and middle income countries all over the world. So yeah, great success from Parcel. And then the next one's Silly. So it's a bit of a weird name, I know, but bear with me. So Silly uses data from satellites in orbit to detect early movements of infrastructure, such as dams, mines, production plants, airports, ports, buildings, many other things, but all of this from space to millimeters of scale, which is incredible, really. And they actually do it. It's not just made up. It's been proven through the lab. And Silly can monitor a whole country, a city, or zoom in on a specific building or site. And the company monitors shifts, deformations, sinking, subsidence, and a bunch of other stuff of infrastructure over large areas anywhere in the world. And this completely opens up new capabilities for insurance, energy, and real estate industries. So for example, with a dam, you can take measures to prevent trigger events. So if you know that the dam's move slightly, you can repair it before it actually bursts. Or you can take mitigation measures to reduce the size of losses. So if a dam's about to burst and you know you can't stop it burst and you can't repair the dam, then what you can do is you can evacuate all the people in the town downstream, so then you don't get huge amounts of deaths and obviously costs to do with those deaths that need to be indemnified. So whilst in the lab, Silly used their mentors' past events data as well as their own to see if their technology would have empowered insurers to do anything differently to prevent the huge losses experienced in those past events those insurers had experienced. And they looked at the example of a dam busting and realized that a year before there was a massive jerk in the dam that wasn't realized by people on the ground, but was realized from satellites from above. And progressively, in the couple of months leading up to the dam bursting, there was millimeters of movement where it's slowly moving until finally it exploded and the dam bursted. And from this, it was realized that if Silly had been used, it would have identified that there was a problem, there was a movement in that dam, and then the actions that I spoke about earlier could have been taken to either stop the event from happening by repairing the dam, or taking those mitigation measures to stop the amount of damage that had occurred downstream of the dam. So as you can see, there's a massive benefits to this, such as allowing underwriters to take bigger lines because they know they can take measures to prevent risks from happening, or to prevent the size of risks happening. And it also allows them to underwrite with more confidence because their data that they're getting is more accurate and more precise, and it allows them to make quicker decisions as well. So I spoke a bit about the past cohorts in the lab, but you may be wondering, we've got so many different things happening here at Lloyd's in innovation at the moment. How the hell does it all come together? So that's where parametric insurance comes in. So this is different to Parametric Insurance. It's a company called Parametric Insurance. So first of all, let's talk about the report that we wrote. So this is an emerging risk report we wrote in 2018 called Cloud Down. And in this report, we spoke about how current business interruption insurance only covers cloud outages after 12 hours. So what I mean by the cloud is a lot of companies now use cloud services such as Amazon Web Services or Google Cloud to provide a lot of their business functions. And without the cloud, they can't function as a business. They can't sell to their consumers. They can't internally communicate. So it's a massive issue. But as I said, business interruption wouldn't kick in. So businesses could go down for a whole day without there being any indemnification, which is a massive issue. So Parametrics read this report and were like, oh, there's an issue here that we could maybe provide a solution to. So they submitted an idea via the PIF, a form sent off to the PIF. And basically what this idea said was they could provide a parametric insurance product. So what Parametrics can do is they can ping servers globally across the world. These servers are the cloud servers. And if the ping isn't responded to or returned, they know, okay, that server's down. So what it will do is it constantly or at regular intervals sends those pings out. And if a ping isn't returned for more than, let's say, an hour, then a payout automatically occurs to the company that would be receiving those cloud services. So it's a great idea, and it reduces the amount of time that is needed for cloud downage for there to be a payout and for indemnification to happen for the client, which is a great from their perspective as well. So the PIF members, so those 27 member syndicates that I spoke about earlier, they were really impressed with this idea. They felt like it better met the client's needs. So they decided to sort of take it on and take them under their wing. And Parametrics also joined the Lloyd's lab in cohort 4. So they tested their product. They didn't sign full-on deals during the lab, but with the lab, what we expect is relationships to be formed for then deals to be made, I don't know, in the months following the lab. So it's all about starting that relationship, starting those conversations, and then the action sort of happening after the lab, through the lab. And then as a result of those initial relationships being built, now they have actually launched a product with one of the cover holders as well as syndicate at Lloyd's, and they're now also looking to become a Lloyd's cover holder. So you can see from the report, through the PIF, through the lab, to now sort of having a visible impact on the insurance industry, really shows the sort of power of the innovation programs that we are running at Lloyd's. So thank you for listening, everyone. I hope you enjoyed my presentation, and me and Ed will welcome any questions.
Thanks, James. Yeah, keen to hear if anyone's got any questions about what we do, whether it's about the reports, about the InsurTech Accelerator, the Lloyd's Lab, or any other things we get to. Be delighted to help clarify any queries that you guys might have.
We do have a couple of questions in the Q&A, and thanks, James. That was a great overview of what's going on in the lab and with innovation. Thank you so much. So one question, this comes from Mike Cremines. What are the latest innovations to cover blockchain in the market, in particular flow. Do you have any insight into what's going on with blockchain?
I'm not quite sure what they mean by flow in particular, but in terms of blockchain related and crypto, we've got a we've got a theme at the moment in the lab for crypto, and we've got two insurtechs working with us in this space. One called Superscript, and another one called Merkle Science. And what they're looking at, what Merkle are looking at in particular, is helping understand the customer. And what Superscript are doing is directors and officers insurance for crypto companies. And so what's interesting is it's actually what they're doing is kind of traditional insurance, conventional insurance, but for crypto businesses, really. So crypto businesses will still need directors and officers cover, but you need to understand the business and the specific risks that crypto kind of businesses are facing. And then what Merkle are doing is they're working with like governments and police and places like that to help create something. They've called it KYBB. So instead of KYC, know your customer, KYBB is know your blockchain business. And so they're actually like using the data that they capture and the insights they get around transactions and events and things that are going on with various blockchain or Bitcoin accounts, and trying to establish what the risk might be associated with insuring a business that's doing, a company that's doing business with them. Because as you know, like stuff that's on the blockchain, it's public, you can see what's going on, but the accounts are anonymous. You don't know who you're dealing with. So that's something interesting going on in terms of blockchain more widely, and the kind of the technology of blockchain and how we use that. I think we kind of went through a bit of a hype cycle with that in, I'd say, like maybe 2018 or maybe up to 2019 as well, where there was like lots and lots of talk and excitement. But then kind of around that 2018, 2019 time, people started to kind of think, well, I've seen all this talk and I've not seen much come from it. And now we're in the trough of disillusionment, as Gartner would call it, I think, with blockchain in terms of a technology. It's definitely got some uses. It's not been as delivered as much as the hype would have indicated back in 2016, 2017. But yeah, what we're seeing now is rather than companies selling themselves as being a blockchain business, or saying, oh, we do blockchain, which used to be kind of like the USP, and people would say, oh, we do blockchain, just to kind of get people to go, oh, wow. They don't do that anymore. People just kind of, as a side, on the side, mention that they use blockchain in their business or whatever, and because they think it's valuable, but they don't kind of market themselves as being blockchain enabled like they used to. It's much more rare to see that now. So yeah, to answer your question, those that we've got Merkle Science and Superscript that we're working with on crypto, and in more general blockchain, companies are using it, but it's not kind of it's not got that cool element to it anymore.
Brilliant. Thanks.
Cool.
Go ahead.
Another question, yeah. Martha, are these sensors a required condition of binding coverage? Will their use or refusal to use affect premiums? So no. These are new products that use the sensors, and so yes, if you're going to take that product, you'd have to use that sensor, but you can probably get cover elsewhere in another way. But the benefits of using these sensors and using this insurance product is great. So if we take the parcel example, parcel are the ones that have that sensor that goes in cargo containers for example, vaccines, and they're insuring the COVID vaccine. And the benefits of using that is that they can create a parametric product out of it, because if the temperature goes above whatever, we all heard that the Pfizer vaccine, for example, needs to be kept at minus 70 something degrees centigrade, or I don't know what that is in Fahrenheit, 2 million or something. We don't deal in Fahrenheit here. So we know it had to be kept below a certain temperature, and that sensor will tell you if it's breached that condition, and if it's breached it for long enough that now you no longer trust that vaccine. And by having that sensor and having that packaged up, it's a win for everybody, because one, you don't end up transporting it any further than you need to and wasting cost and time. 2, you don't give that vaccine to somebody when it's not going to be any good for them anyway. And 3 is it reduces the time and the cost of processing the claim. So we can process the claim much more quickly. We know that the vaccine's no good. There's no more evidence needed. No claims adjuster needs to go see it. We just know we need to pay that claim. They need to order more vaccine to that customer, and everything's much more smooth and efficient. So the benefits are huge of using that kind of solution, and that should then reflect in the pricing and the customer service you receive.
Can I add on to what you said, Ed? So I think another interesting thing with the whole parametrics and the sensors is like another company that's come through the lab, Flood Flash. So obviously when there's areas of mass flooding, it's really hard for loss adjusters to go in and then sort of evaluate the claim and pay out, give all the information to the insurers for there to be the payout to the customer to get the money they need to sort of recover and indemnify. So by having those sensors there that Flood Flash do provide, it means that the customer sometimes even gets a payout even before they know that they've had a loss, and it means they have the money faster so they can react quicker and indemnify themselves quicker, get back to the situation they were in before the flooding happened faster, because they have the financial means to do so. They don't have to wait for someone to go out there, which can take ages and ages and ages when there has been a flood event. So it overall improves the experience of the customer.
Just one qualifier on that is that Flood Flash did pay a claim. They paid a claim before the customer knew they had a claim, which is great. It was within like 8 or 9 hours of the peak flood, the customer had the money in the bank, which is like, I mean, that's supersonic. But it's not an indemnity cover. So it will be, the thing about this kind of parametric cover is it's a set payment based on a certain event. And so it's not normally designed to be like a comprehensive cover for the full loss. So for example, the flood, let's say they get they have a 1 meter, like 3 and a bit feet of flooding in their property, and they know they've already agreed when they write the business that they want a $50,000 payout. They'll get that payout, and that'll be very quick, and it helps them kind of deal with the initial problem. But they might need further insurance and their further insurance policy to indemnify and get them back to exactly where they were in the past. But the beauty of the parametric product is the speed of the payment and how you can get that done very quickly and get you minimize the overall business interruption as well. Thanks, Ed.
Awesome. Cool. That actually reminds me, we did a Tuesdays with Lloyd's session on parametrics in September. So again, if the people who are watching this, if you go to our YouTube channel, you can find that video in the Tuesdays with Lloyd's playlist. I've got a question for the two of you. The Lloyd's lab is just mind-blowing. I think it's so fascinating, and I've been able to pop in a couple of times when I've been in London to see the folks who are working there, and it's just really exciting that it's right there in the building. It's so accessible, and so much cool stuff is coming out of it. Can you tell us a little bit just about what the pitch day is like, where the people from the cohort pitch to folks in the market, and what that's all about? Because I know it's super exciting and kind of intense.
Yeah, that's a great day. I mean, the last three of those have been remote, like online. It's funny, it's showing James's face even though I'm talking, so it's probably confusing you guys.
There you go.
So the last 3 have been remote because of COVID, obviously, but we're going to do the next one. Idea would be face to face, and it's a great day because what we do is we've filtered out. Let's say the last cohort we had 179 applications. We filtered that down to 24 applications, and then they all have 5 minutes to pitch and 5 minutes for questions. And so it's a real fast-paced day with loads of really wild and exciting ideas coming to the fore. And at the end of that, at the end of each pitch, the market votes on what they think about those teams. And so at the end of the day, we know pretty much straight away which teams are going to make it into the cohort. So it's kind of it's pretty tough for the insurtechs to come up with a 5-minute pitch about what they do. Some of them really struggle, but it's really important because I can tell you what idea, sure. Because like it's really important because like there's only so long you can hold someone's attention, particularly when you're talking about a new idea. And if we want to enable the teams to, we want to get like pick 10 of them, we need to have enough like to whittle down to 10, and 5 minutes pitch, 5 minutes Q&A is all about all you can get away with. In terms of wild ideas, yeah. Well, I mean, pardon?
The IVF one. That was a pretty good one.
I mean, that's the wild idea that made it through. Yeah. Okay. IVF insurance. So, I mean, you don't think about IVF insurance when you think of Lloyd's, but we had a team pitching IVF, and what they're looking to do is to, they've got like 1 million examples of couples who've gone through IVF, and about to launch, hopefully, at the end of this year or start of next year, going to launch a product to cover couples who go through IVF. And like, it's such an uncertain thing, and it's expensive. I mean, we can't make it any cheaper, but what the product is looking to do is say that if we think based on your data, it'll take you this many cycles to get a live baby at the end, like not pregnancy, but a live birth at the end. And if you don't have a live baby at the end of this, what we agree we think we'll do, then you'll get most of all your money back. And so stepping into that journey of IVF, like stepping into that journey, you know that either you're going to have exactly what you want and what everyone wants you to have, or at least the worst case is it costs you your insurance premium, kind of thing. And so it just means it takes so much stress away from what is a really stressful situation. And like that being pitched at Lloyd's Lab is like, it's such a wild idea compared to the normal stuff we get about like hurricanes and flooding and all that kind of stuff. So that's quite an interesting type of thing that we've had come through.
Cool, neat. I wanted to ask you, how involved are the underwriters in the market in mentoring the startups that are in the cohort?
The mentors, the underwriters, and so forth, they are the special sauce of the Lloyd's Lab. So they're what make it what it is. So the quality of the interactions, the engagement, it's all about the mentors, basically. And so, yeah, it's great. We typically have between 2 to 8 mentors for each team that come through. And it's a big variety because we don't allocate people. People decide they want to mentor a team. And so they're all people who are engaged, they're committed, they love the idea. They think there's a personal interest, a professional interest. And so basically everyone's incentives are aligned to get a great outcome. So the mentors are the special source, and it's their advice, their connections and their data, which really makes the Lloyd's Lab what it is.
And I think also adding on to that, they also help drive the themes that we choose. So like, as I was saying, we have like the crypto and all that type of stuff. They're the ones that help us choose those themes. So it means that the insurtechs that actually do end up in the lab are catering to what the market and what those underwriters actually want. So yeah, that's another really important aspect of it as well.
Cool, thanks. That's good to hear. But before I let you to go, I had one last question. James, you're part of the graduate program at Lloyd's. I don't know if a lot of people who are attending today know what the graduate program is. Could you talk a little bit about your journey and what you're doing at Lloyd's?
Yeah, so I'm relatively, well, as I said, I'm new to the insurance industry, and I didn't really know anything about Lloyd's of London. The only Lloyd's I've ever heard about is the bank. But I went to an event, and you go up to these events on careers events and go up to all the stands, and I gave my CV to a bunch of different stands, and then I got an email from Lloyd's inviting me into the office. So I was like, okay, free trip to London, and then I'm going to go out with my friends afterwards. So because I used to live a bit further away. So I came down to the office, and then you go into the underwriting room and you're like, whoa, this is a serious place. And then they give you the speech that I just gave you about them insuring Ronaldo's legs, them insuring the Titanic, them insuring spaceships. And you're like, oh, seems pretty cool. And it's very related to current affairs as well, which is something that really stood out to me. So I applied to the internship, managed to get into the internship. That was all during COVID though. So we just got an overview of the company. And then I applied to the grad scheme, got into the grad scheme, and I'm actually on the insurance grad scheme now. So we don't only do rotations. So we do 4 rotations, 2 are in the corporation and 2 are in the market. So that actually means that I do a broking placement with one of the brokers at Lloyd's, and I also do an underwriting placement with one of the syndicates and down at one of the boxes at Lloyd's as well, which is something that I really liked as well. But it's been a great experience so far. I'm not even just saying that because Ed's sitting next to me, but the amount of events that we go to. So as I was saying before, Instech London, they run some great events. The amount of people that I meet. So we've been having insurtechs come in today, speaking to them. The insurtechs that are also in the lab, they know their stuff. It's great to hear them, and and also the PIF meetings as well. You're with very senior people from all across the market. So great exposure. I highly recommend it to anyone who's looking to apply, if there's anyone on this call, but I doubt it.
Probably not from the US, but
I think they do run an internship in the US, though, but I could be corrected by Mark.
We do some internships here in the US in the corporation, and it's been just a fabulous experience for us, and hopefully for them too. Well, that was great. Thank you both so much for taking the time to talk to us from London. Wish you all the best, and we look forward to getting over there soon and seeing you. And for the people who are watching, I put a link to the Lloyd's lab in there. So if you've got any questions about the lab, anything for Ed or James, you'll find their contact information there. So thanks very much.
Thanks, Mark.
We'll see you again. Cheers.
Thanks, everyone. Bye.
So, folks, we've got one more presenter, Pat Talley, who's going to really give an overview of what's actually going on in the market right now. But why don't we take a little break? I'm going to throw up another poll, and it's like 25 after now. Why don't we come back in 10 minutes at 10:35, and we'll pick it up again with Pat.
Hello, Mark, are you still there?
Hey, Pat, I'm here. Hi, everybody. We're back. Thanks for filling out that poll. I want to share the results. Pat, we were asking them about whether they'd like to attend in-person seminars next year, or do they like the virtual format? And it's almost 50-50. It's really interesting. You know, I think it's so much fun to get together if it's safe and it's possible to do it face-to-face. But I think one of the things that we found in the past year is that year and a half is that doing these virtual events, we're able to get people to speak from all over the world. I mean, it's so great to have that reach. So
that's striking that it's an exact, it's a dead heat.
The dead heat.
It really sort of speaks to what I think, you know, I was going to touch on this later a little bit about, you know, what will new normal look like. And I think this is a perfectly indicative of that it's probably going to be some sort of hybrid where we have some in person and some continuing to be virtual.
Yeah. Emma Meyer asked, can we offer both? And that's probably a good way to do it. And I've always wanted to figure out a way, even if we're doing them live, to broadcast them like we're doing with this right now. And it's a lot easier to do that now.
It is, and I think there's some people, there was a concern that if you go virtual and in person, that you'll, you know, the virtual aspect of it will cannibalize your in person. But I would think we found that that is not the case. That there are some people that just, you know, it's a personal decision based on your schedule and your location. But some people want to go there and have it in person. Some, you know, do it remotely. So I think it's really kind of the best of both worlds, and they can both, you know, peacefully coexist.
Well, let me ask the folks, what would you be willing to attend an in-person networking event next year? Because we don't only have to do seminars, the association, it's also possible that maybe we could do some a couple of networking events through the year to supplement the educational seminars that we do. And they might have an educational component to it. You never know. We could also do that. I just wanted to let everybody know, Pat is the last part of our program, and we're really excited to have him here. He's a regional director here in the US. Many of you know him personally. He's also the managing agent practice leader for Lloyd's in the US. And I might add, our finest host on the Tuesdays with Lloyd's webinar series, which you can see on the link to Lloyd's YouTube channel. I'm going to give a plug. We did a session Tuesday with Atrium Syndicate, their leadership, and it's also on YouTube. If you didn't see it, I encourage you to go to our YouTube channel and watch it, because it's a fascinating. It was a great program, lots of insights. Okay, it's looking like I'm going to share this. That's good to know. It looks like people would take the time to do a face-to-face networking event. So that's good feedback. The board of directors of the association is going to be getting together in the next few weeks, and we're going to start planning our events for next year. So that's helpful information. Okay, that's enough for me. I'm going to turn it over to, wait, I'm doing two things at once. I'm going to turn it over to you, Pat, and it's all yours.
Thanks, Mark. Yeah, you beat me to the plug. I'm going to talk a little bit about Tuesdays with Lloyd's, and in particularly the Atrium session, which, as Mark said, was really striking, and we'll go into some detail there in a little bit. But thanks for inviting me to do this and having me here today. I am Pat Talley, for better or worse. I'm Lloyd's U.S. Central Region Director, and also, as Mark said, lead up our newly established managing agent practice group. I always like, I know a lot of you in this audience, I'm sure, but I always use this old openings line here that just like our previous presenters from Lloyd's, if my heavy British accent is too hard to understand, just signal Mark and I'll try and slow down. That's the thing I don't like about Zoom. You get no feedback. I'm assuming you're laughing uproariously at my joke, but in any event, no, I'm actually based in Kentucky. And as this is a serious discussion, I committed to wearing shoes today. We're on Zoom, so you'll just have to take my word for that. But enough with my lame jokes. I just want to, again, I for one, to go back to Mark's poll questions, am very much about getting back out and about. I mean, it was a cold, hard stop back in March of 20, and I'm very excited to be going to WSIA next week. Mark's going with us, and so it's good to get back out there. I mean, you have to be cautious and do things the appropriate way, but it's just I'm tired of the basement. So anyway, I thought I would take about 45 minutes today to cover a variety of topics and really just kind of bring you up to date on some things going on at Lloyd's. There's a lot going on in the market, both across the pond and over here. Well, I guess for that matter, all around the globe. So I hope to touch on several of the I guess the bigger ticket items, but mainly I want to try and focus on some of the things that Mark and I both think that would be of most interest to this group. So let's really kind of just jump in and kind of set the stage with a little bit of a macro view and summarize the current state of Lloyd's U.S. trading footprint and the overall outlook. I am going to spare you PowerPoint slides. We don't want any death by PowerPoint, so I'm going to cover a lot of ground. I could support it with slides, but I think I was just going to kind of make it more conversational. So where does Lloyd sit right now in terms of its penetration in the U.S. market and its how it's faring financially? Surplus lines premium in the U.S. continues a strong growth trend. And in 2020, the Lloyd's market wrote $12.8 billion in surplus lines premium, which gives us about a 22% share of what is around a $60 to $65 billion market. 2 years ago, I think we got as high as 25%. So that's tapered a bit because there have been, there are some additional entities that have entered this space, and it's gotten to be more of a competitive market. But Lloyd's is still far and away the number one market for E&S, excess and surplus lines in the U.S. So to put it another way, Lloyd's share is I saw this the other day, and it was kind of a striking statistic. Lloyd's share is larger than the next 5 competitors combined, which would be AIG, Markel, Berkshire Hathaway Specialty, Berkeley, and Nationwide, what was formerly Scottsdale. So it's really, this really is Lloyd's space. It again is a specialist market. It really just lends itself to the E&S space because you have freedom of rate, rule, and form. When you're writing a very complex asymmetric type risk, it's hard to do that on filed forms. I mean, a lot of these things are, to use an English term, bespoke and highly stylized to a particular risk. So that's the E&S space right now. Moving on to reinsurance, Lloyd's which is Lloyd's second largest focus. The market wrote in 2020 right at $6 billion in reinsurance, giving it, I think, about a 5% share of that market, which I think is around $120 billion total. So that places Lloyd's in fifth place behind National Indemnity, Swiss Re, Everest, I think AXA. There's 4, I think. So, and that's typically sort of where we've been for the last few years. We've moved around from 5th and 4th, but in any event, a significant player in reinsurance. Then we have a little segment in the U.S. of what we call exempt premium, and that's really premium that is, for whatever reason, is exempt and takes it outside the surplus lines umbrella. It could be marine, some types of aviation, transport, MAT, MAT exemptions, and then there some states have industrial insured exemptions, things like that. So that amounted to about $1.7 billion in premium in 2020. And then lastly, you take our 3 licensed platforms, Illinois, Kentucky, and the U.S. Virgin Islands, and that added about $200 million in license premium. So in total, Lloyd's just about touched $21 billion in U.S. business in 2020, which is, I don't have the exact percentage, but that's in excess of 40% of Lloyd's total global book. So by any measure, Lloyd's, the U.S. is and historically has been the most significant market for Lloyd's. When you couple that with Canada, it's another several $billions, and it eclipses around 55%. So the North American footprint here is very significant, and it's one reason there's so much attention in London on working on this most critical market and developing additional, whether it's support systems, technology, enhancements to distribution. That's really critical in this market. So how does this business come into Lloyd's? As many of you know, Lloyd's over the past several years has really ramped up the use of delegated authority. We use sort of a term of art, cover holder, which is simply an entity that holds Lloyd's pen via contract. And then we have our open market placements. But the cover holder segment has been rapidly growing, a rapidly growing part of Lloyd's distribution system, because really it's just a very efficient method to process, particularly high velocity, low premium risks. You can't go down and march around the room and sign down a risk for a $1,500 premium. It just doesn't make economic sense. At the end of 2020, I think we had 1,231 cover holders, discrete cover holders in the U.S. that produced about 37% of our premium. So that's if you go back 10 years or more, that was not nearly that significant of a part of our distribution network, but it is consistently grown. So you taking all this into account, you might imagine that you can see why the U.S. is a big focus for Lloyd's, and our CEO John Neal has reinforced this to us many times, that we are a key strategic focus, which makes us all feel good, because we like to see what they have in store for Lloyd's to raise our game in so many areas here in this most significant market. To touch a little bit, I said we are licensed in 2 U.S. states and 1 territory, which I think most of you probably know, but we've been admitted in Illinois since 1929. Kentucky came second in 1937, and the U.S. Virgin Islands was in 1971. And that's actually a part of my overall remit, is managing those 3 licenses. I am president of the corporate attorney, in fact, it's called Lloyd's Illinois Inc. and Lloyd's Kentucky Inc. So as attorney in fact, we simply hold the durable power of attorney to act on behalf of underwriters in all matters relating to the 3 licensed platforms. Because obviously, the underwriters are not here, they're across the pond. So we deal with service of suit, regulatory issues, filing of wordings, and those sorts of things, and generally have authority to manage the affairs on the market's behalf. Another little joke I use here a lot, some people that I meet will say, "Oh, so you're an attorney?" And I'll say, "No, I am an attorney in fact, but I am not, in fact, an attorney." So uproarious laughter, I'm sure, again, I hope. But the reason I'm bringing up the background on the licenses is that the executive committee and the council at Lloyd's made the strategic decision about 18 months ago, I guess, that moving forward, we were going to focus solely on our key focus in the U.S., which is, as we went across earlier, the surplus lines market. Like we said, Lloyd's is a specialist market. It just fits nicely into that E&S space. And the 3 licenses, conversely, while they collectively produce about $200 million in premium, which certainly is a large number in and of itself, but as a proportion of the overall U.S. business, it's right at 1%, and it's been flat for several years. So they made this determination to relinquish those 3 licenses. And we're in the process of doing that right now. As of July 1st of this year, no new business can be written in Illinois and Kentucky, and all the existing policies as of January 1, 2022 have to be either non-renewed on their next policy anniversary date, or transition to the surplus lines market, or we're seeing a fair amount of, we're seeing some of that being migrated over to a fronting arrangement. So, which I'm sure you're familiar with. So, a carrier can pay a fee and have rated licensed paper, and it's simply, it's placed on that, so they have access to those markets. So, in the Virgin Islands, we are taking a longer time to do this because Lloyd's is about 40 or 50% of the entire market in the Virgin Islands, and we didn't want to be do anything that would be overly disruptive. So we're taking a longer view on that. That there, no new business can be written after January 1st of 2022, and all policies have to be non-renewed or transitioned after January 1st, 2024. We actually think we will retain a lot of the USVI business because it's largely the vast majority of it is cat exposed, coastal. And we think that just will naturally migrate to surplus lines because we're not aware of or don't see any of the standard markets who are, standing in line to step into the breach and pick up that much cat. How much is that much cat? Well, just to give you a little bit of an insight, in 2017, hurricanes Irma and Maria did a tremendous amount of damage in the Virgin Islands, which is, you've got St. John's, St. Thomas, and St. Croix, and just did. They're still recovering from it. I went down there on a claims-oriented mission down there with some people from London, like a month or two after them. And as we came in, I thought, oh, look at all the swimming pools. No, they weren't. There were blue tarps everywhere. As you got down closer, you could see there were so many roofs that had been lost. And so to give you a sense of the scale of that, which those islands are maybe 20 or 30 square miles, not very large. But in that year, 2017, I think we wrote about $75 million in premium there. And last I saw, which they're still being played out, the claims on that are well in excess of $500 million and probably multiple, way on up beyond that. So it shows you, but to show you too, the resiliency of the market and the appetite that Lloyd's typically has. You think that after that kind of a 1 in 200 type claim that the market may have pulled back, but actually the reverse happened. It happened in 18 and 19. We saw record premium amounts in the USVI. Some of that was gained through de facto rate increases, just real simply because underwriters removed some various discretionary discounts because it was just the building standards have had to be modified and things. So anyway, in any event, that's one reason why I'm going a long way around the barn while we're taking a longer view in relinquishing those licenses. So, and once those dates have passed, the licenses will actually be there still for several years because we'll be running off that business and still have be subject to all the regulatory reporting and that sort of thing. So enough about that. That's kind of giving you a little bit of the flavor of the U.S. picture. So next, I want to touch on a little bit of the impacts of COVID. I mean, which hopefully we're putting COVID more and more in the rearview mirror. I certainly hope so. And what was the effect of that on Lloyd's over the last 18 months? Well, a couple of things come immediately to mind. As you may have seen, the underwriting room, which is the absolute alpha and omega, it's where everything happens at Lloyd's. It was closed for most of 2020 and has only it's after a couple of false starts because there's been this resurgence of Delta and other things. It's only really recently begun to be continuously reopened on sort of a limited basis. But I think everyone was pleased to see that this, what was going to happen. There'd always been hypotheticals. What if you couldn't go into the room? What would happen? How would the market behave? Could it continue functioning in a fluid manner? And there's no better way to test that than to be thrown into the deep end of the pool and see if you can swim, which is really what COVID did. But at that point, the market had successfully brought online a significant amount of PPL, automated placements, computer system redundancies and things. So even though everyone left and was working out of their homes or wherever, the market pretty much plugged on very well. I think a lot of people I know everyone was just really pleasantly surprised to see how well things functioned remotely. When you're talking about a in-face type person-to-person business that had been going on for nearly 340 years, when you upend that, it's rational to say what's going to be the direct consequences and the unintended consequences. But all in all, fared very well. So now we're back in the, and what is that? What does that mean? You hear people talking about what does that mean for the future of face-to-face negotiations and the future of the room? Well, like I said earlier in our slide when we showed that 50-50 dead heat in the poll, I think a lot of work situations, and Lloyd's is probably no exception, will be going back to some semblance of how they were before. But I don't think we're ever going to see a wholesale return to the way things were in January of 2020. I just think you're going to see more. This has opened a lot of eyes in terms of what functions and capabilities lend themselves to Zoom and online and virtual execution, and which don't. And I think we've seen collectively as an industry and as an entire economy that much more can be done than we think. So I think as you go forward, it's going to have a rethink. Is it 3 days in the office for some people? Maybe 2, maybe none, depending on your function, what your function is. And I think we've seen massive strides in technology and the proliferation of these hop in and Zoom and Teams and how they've really raised their game and their offering so that it makes it more seamless. So I don't think I think that with respect to the underwriting room, I think we'll see it there, and that's an integral part of this business. But I think it gives us much more flexibility in how we're able to continue our business from anywhere and everywhere. So that's one thought on the effect of COVID. The other is obviously the financial impact. And here are a couple bits to go into that. In 2020, Lloyd's as a market produced collectively a 110.3 combined ratio. So as I'm sure all of you know, that for every dollar of premium that was earned, $1.10 went out the door. That's not a good thing, and at least in the long term. So, but to give you some appreciation for how impactful cat events can be, Lloyd's combined ratio net of COVID was 97. So think about that. You had some other cats mixed in there, but a lot of that is just the nature attritional. But so over 13 points of that ratio is COVID cat from the BI claims and all those related things that go in there. So just and the thing is, that's not something that what do you think the chances are that a global pandemic is being priced into things? So that's the thing you look out for. What's this thing coming out of left field? And it's also another reason, it reinforces the notion that Lloyd's is always an innovator and is always scanning the horizon for what are emerging risks. What's the next asbestos, or what's the next fill in the blank, cyber, things like that. We have a great slide on that typically where it shows that Lloyd's was the first motor policy ever written, and first aviation, and first satellite, and first political risk, and first cyber. So this is one of those things that really I don't think anyone could see coming, but yet had a massive impact on financial operations, and then also speaks to why it's such a good thing to know that Lloyd's has this redundant capital structure, the central fund and those other elements which provide to its financial resiliency, that we can take these sort of hits and just kind of brush them off and keep on rolling. And that's I think one of the most important elements to keep in mind about Lloyd's is that unlike other surplus lines carriers, the surplus lines market in general, it doesn't have a guarantee fund. It's not admitted, but Lloyd's has provided for this internal mechanism to ensure that all valid claims are paid, and we've been able to do that for 3 centuries, which is just an amazing testament and statement to that resiliency. So I guess that gives you kind of some scale about the financial impact of COVID. And one good thing we heard just recently, which I think surprised many of us, John Neal, our CEO, made the statement that despite continuing effects of COVID, California wildfires and everything else, Lloyd's at present is still at a sub 100 combined ratio at this late hour in the year. So touch wood, because a lot of things we've seen hurricanes come up and zoom up the Northeast in the middle of November and things. So it's not over till it's over. But that's striking kind of commentary on what's the changes that have taken effect at Lloyd's in terms of the last couple of years remedial performance initiatives to make sure that each and every one of our syndicates are writing in a diligent and measured fashion, that they're doing all that can be done in this very complex environment to ensure profitability. And I think that's starting to show real fruits of those efforts that have been going for a couple of years. So while we're on the, I guess we want to look at some of the silver linings, I guess, of COVID. One other thing that came out of that is, as a U.S. market development team, which Mark Rector and I both work for, everything shut down in March of 2020. I remember I was at an insurance industry charitable foundation dinner in Chicago. I think it was March 7th or something, and just 300 people at the Four Seasons or whatever, 8 people at a table, passing the dressing and the bread and everything else. And then I flew home and everything came to a stop. And I'm thinking, that's when it really came home to me that, wow, was that a super spreader event? I mean, it turned out not to be, but we just didn't know what was coming around the corner. So, we sat around a lot of our team and thought, what can we do? Is there anything we can do to stay virtually connected to our stakeholders? Because we're so used to being out and about and doing presentations and meeting and working with all manner of stakeholders. So the idea came up to produce an online virtual series of discussions with Lloyd's underwriters and our U.S. stakeholders, be they retail and wholesale brokers, underwriters, cover holders, service providers, and so on. And so that was the genesis of Tuesdays with Lloyds. It was born, and which Mark said, we hold that on Zoom typically twice per month. I'm sure hopefully several of you have seen or are aware of that. And since it debuted, it has really taken off. We've had all sorts of experts that will form a roundtable and allow audience interaction. It could be on a class of business, might be cyber or a sharing economy, property, casualty, FinPro, on and on. We've had held in-depth interviews with Lloyd's CEO John Neal and our chairman Bruce Carnegie Brown. We typically have a couple of hundred viewers that come into that. One thing we've noticed, it's interesting. We'll have 500, 600, 700 RSVPs, and we invariably end up with about a 23 or 25% actual participation rate. So it's very predictable. But that shows, I think, it's different. If you sign up for a conference in Toledo and you pay a fee and you got a flight, I mean, you're gonna go unless something really big happens. But here it's, there's no cost of entry or exit. You click it and you decide that day you're gonna do something else. You don't have to attend, and there's no penalty for that. But as Mark was also saying, and I've got to get my plugs in here, we stream those events live on our YouTube channel, but they're also recorded. So we are developing a growing library of dozens of interviews, roundtables, and what we call syndicate showcases. We've done 7 of those, where we bring on the C-suite from one of our managing agents, and we have this just fireside chat type of conversation, and they can be as expansive in their comments as they want, and the audience is able to ask questions. What are your U.S. business plans? What's going on? Where are you growing? Where are you contracting? This year we've profiled Apollo, Hiscox, Munich Re, Amlin, Atrium, and as Mark said, that I really, since they're recorded, I really encourage you to go and watch some of those. Mark, I'm sure you've dropped if you haven't yet, you can drop the link in the chat to the YouTube channel. We've gotten surprising uptake on that. Some of these videos have been viewed a couple hundred times. So some of that are people that couldn't make the live stream and they did it later, or people that have watched it but want to go back and see a particular section because it's like your DVR. You can record your favorite show and skip through the commercials and all that sort of thing. So that's been a boon that we really weren't anticipating. So we're really working to beef up that content on the YouTube channel. And as Mark said, the one we had with Atrium last week or 2 days ago was amazing because we had 7 representatives. We had CEO Richard Harries, 2 underwriters, 2 claims people, and their newly hired head of U.S. business development. And you should watch it. There's 2 particular areas that I thought were particularly informative. They go into a fair amount of detail on the technology that they are using on claims, and it will just blow your mind the advancements that are being made in the recording, adjusting, and payment of claims. They, using drones and mapping techniques for California wildfires, for example, where the technology is such now that a claim can be pre-adjusted and perhaps even paid sometimes before the insured is even aware there's a loss. We've seen the same thing in adjusting claims for Irma and Maria because of the geo locations technology and things like that. It's just amazing what you can glean from something where used to be you had to physically get on the ground and look at it. So that's a great thing that they did, because it really fits into Lloyd's whole commitment, and Lloyd's is as part of its Future at Lloyd's initiative is working to create a streamlined and transparent, digitally enabled claims process to just really take it to the next level. I had a couple points on it yet. Once this is instituted, stakeholders will know exactly where they are throughout the life cycle of a claim, which results in a much faster settlement time and improved, overall customer experience. The cycle times will reduce and payments will be quicker by linking relevant loss and policy data and automating certain aspects of the claims handling process that creates a seamless interface with the carrier's claim systems. And then the new support services and communications and collaboration tools are being brought online that'll be able to deliver support to all the stakeholders involved in the claims handling process throughout the claim life cycle. So lots going on in that space. So again, I would encourage you to watch that. They also talked quite a bit about a system. They were one of the first to initiate an online quote bind issue system, which AU Gold, which is still in use today. It's been modified. They continue to grow that system, and so that's an interesting part of it too, because it speaks to not the importance, but the criticality of this, the inevitability of the role that technology is going to play and must play in the future of distribution in this industry, not just Lloyd's. I think we're just going to continue to see amazing changes in the way that these products are distributed and managed throughout the globe. Next, I want to talk just a bit about something that I'm sure you have heard more and more about every day. It's another acronym, ESG, which stands for environmental, social, and governance. So I guess basically ESG are a set of criteria that are a set of standards for a company's operations that, well, in the case of publicly traded companies, so socially conscious investors can use that as a screen for potential investments. The environmental, the E criteria, consider how a company performs as a steward of nature in terms of sustainability and green initiatives and those sorts of things. The S, the social criteria, examines how a company or organization manages relationships with its employees, suppliers, customers, and overall the communities in which it operates. And then finally, the G, the governance, deals with the company's leadership, its executive style, pay, culture, audits, internal controls, and if publicly traded, shareholder rights and things like that. So it's really a complete menu of things. It's not just climate oriented things. There's a whole litany of things that go under that umbrella. And Lloyd's has adopted a significant ESG policy and has pledged to work toward carbon neutrality over time. And I was going to read an extended quote that our CEO John Neal made. I saw it. I think it was on CNBC, or it was a UK based financial network. He said, "We think of COVID as systemic risk. Climate is the ultimate systemic risk. So this is our choice to show businesses, communities, and even governments how we can help." Neil, who was speaking at the COP26 climate change conference in Glasgow, Scotland, said last week, "We've got 25 years of high quality weather data, the frequency and severity of convective storms, ice storms, tornadoes, that sort of thing, right through to the way that hurricane related activity that we see in the US. So we've got amazing data on that. Then the advantage we have is, unlike say life insurance companies where they're making long-term decisions, we are repricing our products every 12 months. So it's a real-time kind of process. And he says, so in real time, we're managing weather and trying to understand weather and then trying to extrapolate that through a climate lens. Looking ahead, Neil was bullish about his sector's prospects going forward. Quote, the insurance industry has $35 trillion under management, so we are part of the solution, if you like, of putting our assets at play to support transition. And then he closed it with this, and he was very emphatic on this. He said, quote, I genuinely think that climate is actually the biggest single opportunity the insurance industry has ever seen. And then, following through that, there are other signs that the market is starting to follow his lead. Beazley, which is one of the largest syndicates at Lloyd's, has announced that it's received in principle approval to establish Lloyd's first environmental, social, and governance syndicate. Reading from this article, once fully approved, Syndicate 4321 will focus exclusively on providing capacity to businesses that perform well against ESG metrics. The syndicate will be led by Will Roscoe, head of the Market Facilities Division. The syndicate was established under Lloyd's Syndicate in a Box framework, which we can talk about probably some other time, but that's an accelerated way to stand up a syndicate than going through the traditional route. And it's been used a few times now to develop things that particularly that need speed to market. It will operate a consortium arrangement led by syndicates 623 and 2623. Eligible clients that meet the standards of the ESG rating scoring criteria will be able to access additional capacity from the new syndicate, said Beazley. So, we're always looking for additional capacity. The syndicate will underwrite on a multi-line basis. In its initial phase, it will accept D&O, healthcare, financial institutions, U.S. cyber, property, marine hull, marine cargo, and aviation. So, and then it goes on to quote Adrian Cox, who's the CEO of Beazley. But in any event, that shows that they're actually making concrete steps forward in the ESG initiative. And then also right after that, Axis became the latest insurer to update its ESG stance. So has Swiss Re and others of our peer group. So it's, a lot's going on in that space. I think you're going to see more rather than less of that moving forward. I want to move forward a little bit and talk about some of the market development initiatives we have going on in the U.S. First, and Mark, we sort of touched on this. For years, the U.S. there are 4 U.S. regional directors, and we've always sort of been broken out by geography, but we've really now structured what we do on a practice group sort of basis. It's more effective in how we interact with our stakeholders. Rod Smith, who's my colleague in Atlanta, leads our cover holder practice group. So his primary engagement point is, working with Lloyd's 1,200 plus cover holders. They have a cover holder advisory board where they've brought in these key cover holders to discuss, common challenges, work on these things together, establish best practices and that sort of thing. And he's leading specifically our attendance at WSIA in San Diego next week, where Mark and I are going. I think there's 6,000 attendees registered. So he and Hank Watkins, while they're there, will produce this big Lloyd's update, which is given out to whoever can attend on site. And we have the head of delegated authorities, Paul Brady, who will be over there with us as well. So looking forward to that. Inya He is my colleague in Dallas. She leads the Lloyd's risk manager practice. As you know and can imagine, a lot of Fortune 500 companies have risk managers that have significant business at Lloyd's. And we've always had a big presence at RIMS, which is their big annual trade meeting. So Inya has also established a risk manager advisory board, and they meet regularly to discuss, their Lloyd's presence, challenges and opportunities, and the same things that Rod's group's doing. How can they collaborate and work better to further their objectives? Then Dawn Marie Black, my colleague and good friend in Vermont, she manages our U.S. broker practice, which I could go on for hours about what's involved in that, because as you know, Lloyd's is a broker market. You can't call the underwriter to insure anything. And so there's a whole litany of work that goes on there. And then I manage the newly formed managing agent practice group. And just to kind of clarify some terminology, you hear people use the term syndicate, and then there's the managing agent. And a lot of times those are used interchangeably, but just for clarity, the syndicate is the actual, when you say Hiscox 33, that's a syndicate. It's where all the risk is placed and the capital exists, and that's where on a year of account basis the risk resides. But the managing agent Hiscox or Beasley or Atrium. That's the organization that actually manages the affairs of the syndicate, that employs the underwriters, the actuaries, and all the various and sundry ancillary services that are there to put the business into the syndicate. So there's a lot of value for us to develop a systematic approach of building relationships with the managing agents. We deal, speak regularly to CEOs or chief underwriting officers or lead underwriters, at least in the top 20 of the managing agents, because to help them build a better understanding of what we're doing here in the U.S. and how we can help facilitate their business plans in the U.S. I mean, we're out and about, so we get really, really good granular market intelligence that we can share with them. We can, advise them on emerging opportunities or advise what the competition is doing. So a lot of things, just to be their eyes and ears here on the ground. Lloyd's Boot Camp. Hopefully, I'm sure many of you have heard of that. That's an initiative that we started 5 years ago. We're out and about meeting one-on-one with people, but like, why don't we bring early in their career brokers together in one location? So we've held it in Chicago, and then we went virtually last year, but this past September, we held it in New York, and we limited it to about 70 brokers that come in, from various classes and various geographies. And then we just give them a day and a half deep dive into all things Lloyd's. Sessions are facilitated by London brokers and underwriters. We have class of business sessions and all sorts of things that really just help make Lloyd's more real from a practical practitioner standpoint. What are the barriers to placing business at Lloyd's that you see? Let's remove those, and then in the end, you and we will be better for it. So that has been a very successful program. We actually were looking at doing 2 sessions, one in New York and one in Chicago when COVID hit and shut down those plans. So, but in any event, we'll be continuing that. Mark can share all the information about that. If anyone or any of your firms have interest in attending next year, I encourage you to look into that. A lot of the other things we do here in the U.S. are based on a saying that Hank Watkins, who's president of the Americas, he always says, "We're here when you're not," and that really says it, because the majority of the market is, of course, across the pond. So we're here every day representing them, be it at RIMS, Target Markets, the Council of Insurance Agents and Brokers, CIAB, the Private Risk Management Association, PRMA, which targets the high net worth space, and several others. And we also believe strongly in educating the next generation that'll run this industry. There's some alarming statistics out there, and I can't lay my hands on them. I've seen them, but it's something really scary. Like 70% of this industry is going to be retiring in the next 3 to 5 years, or something along those lines. A big turnover. So we sit on the advisory boards of several risk management colleges and universities, the Katie School at Illinois State, St. John's, and several others, because the theory is very simple, that if we ensure that the incoming wave of professionals that will run this industry in the near future, if they have a better understanding of and working knowledge of Lloyd's, it will propagate outward, and then the market and they will only be the better from it. So I think we're coming up on 45 minutes. I'm on my scribbles. I think I've run through most of them. So Mark, can you think of anything else we might want to touch on, or if there are any questions? We can try to field some questions if there are any. I won't BS. If I know the answer, I'll give it. If I don't, I'll say so and do the old, I'll get back to you. So.
I don't see any questions in the Q&A, but that was a great presentation. That may be one of the best overviews of the market in the Americas that I've seen. Kudos to you for not using PowerPoint. That
you put down the
really
challenge. Mark
excellent.
said we don't want that, so I'm okay. I might talk as fast as a Subaru guy, but I'm just going to wing it and go from scribbles and notes. And worked fine.
No, that was great. If anybody does have any questions, throw them into the Q&A tool or raise your hand, and I'll let you ask Pat directly. In the meantime, I would just say, Thank you all for attending. We're really looking forward to continuing the Association of Lloyds Brokers educational seminars next year. Based on your feedback, they might be face-to-face. I'm sure there'll still be a virtual component. When you leave the webinar today, a little survey is going to pop up on your browser. Please take a moment to fill that in. It's just 4 questions. Your feedback really helps us do what we do better. So it'd be great to hear from you. And one last time, somebody said, Pat, that your clarification about managing agents versus syndicates was very helpful. And
Great.
that is a really good point.
I was confused for the first couple years about which was what. So this industry is really good about, cobbling things together. And if they can put an acronym on it, they're going to do it. I mean, ASAP.
Yeah, I have a radical suggestion for acronyms. Stop using them. Great. I just dropped the link in where you can get CE credit. This is approved for 3 hours of CE credit for producers in Illinois and Wisconsin. So go to linktoloyds.com. You'll also see information there about Tuesdays with Lloyd series and about other upcoming events. One more pitch. Pat mentioned the IICF as one of the last events that we attended before everything shut down. Tonight, they're doing their Rock for Charity event here in Chicago. It's online, it's virtual. It's tons of fun. There's a link on linktoloyds.com. When you go there to get your CE credit, you can see information about the Rock for Charity tonight. If you feel like attending, it's just like an hour and a half starting at 5, but it's really one of the best virtual events you'll ever attend. It's really good.
It will scare you. Some of the people we work with, I didn't know that some of these guys from Chubb and other places are absolute shredders on the electric guitar, drums, and other things. It's kind of scary.
And they rock. They truly rock. Great. Well, I don't see anything else. Thank you, Pat, for joining us, for taking the time. Thank you all, and we'll see you all in 2022.